$905,000, $889,000, 0.4%, three numbers. Same state, same month, same housing market. And the weird part, all three came from the same organization, but only one of them became the headline. Take a guess, which one? Yeah, the 905. That's the number people saw. That's the number that traveled. That's the number that got repeated. But the other two numbers? They're quieter. And honestly, they may tell you more about what California housing is actually doing right now. So that's what this video is really about. Not whether California is up or down. That's too simple. This is about the gap between the headline and the data. Because if you're buying, selling, or just holding a home in California right now, and you're making decisions from the headline, you may be playing the wrong game. So here's what we're doing. First, why the headline is misleading. Then, San Francisco, because what's happening there is genuinely weird. And then the part that actually matters. What you do with all of this if you're buying, selling, or just trying to figure out whether this market still makes sense. Okay, let's go. So here's the story. The California Association of Realtors, CAR, put out a 2026 forecast. And that forecast said the statewide median could hit $905,000. Record territory. That number got picked up all over the place this spring. Bloomberg, the LA Times, local coverage. A lot of outlets ran some version of it. And look, I get why. California home prices headed for a record is a headline. It's clean. It's scary. It's clickable. But then the same organization, same CAR, releases the March 2026 monthly data. Less noise, less drama, less headline energy. And what does that number say? 889,000. Year-over-year change? 0.4%. 0.4. That is basically flat. That is not a roaring market. That is not some giant statewide surge. That is statistical noise. So just sit with that for a second. Same organization. One number says, record coming. The other number says, market is basically flat right now. And only one of those becomes the story. Now you could say, but one is a forecast and one is current data. Exactly. That's the point. A forecast can become a headline. A measurement tells you what's actually happening. And right now, the measurement is much quieter than the headline. Now, watch this. Redfin is measuring the market differently. Different methodology. Broader property mix. Totally separate data source. And it still points in the same direction. About a quarter of California listings took a price cut in March. The share of homes selling above list dropped. Homes sat on the market longer. So now you have two different systems telling you roughly the same thing. Sellers are adjusting. Buyers are more cautious. The market is not behaving like one giant record-breaking machine. The headline is telling you a third story. And then there's the layer underneath all of this. The one I actually think matters more. The LAO, the Legislative Analyst's Office, breaks California home prices into tiers. Bottom tier, middle tier, top tier. And their Q1 2026 read says the middle and bottom tiers have been roughly flat since mid-2022. That's about 4 years. 4 years of very little happening in the part of the market most Californians can actually afford. So if the statewide median is moving up, where is the movement coming from? The top. That is the part people miss. The median can rise even while a huge chunk of the market is doing almost nothing. That's why I've stopped trusting the sentence. California home prices are rising. On its own, that sentence is almost useless. Which California? Which tier? Which city? Which buyer pool? Because when someone says record on TV, they may be talking about a very small slice of the market. The rest of the state, it doesn't fit as neatly into the headline. So let's go look at it. Start with Sacramento. Redfin has the March 2026 median around $500,000, down about 1.2% year over year, and homes are taking longer to sell. Last year, about 17 days, now about 24, so not a crash. But the market is slowing. A little more room for buyers to breathe. Then look at Zillow. Zillow uses a completely different system, their home value index. Different calculation, different methodology. And Zillow has Sacramento city values down roughly 5%. Now those are not the same number, and they're not supposed to be, but they point in the same direction. And honestly, that's what makes it more persuasive. When two different measurement systems are not identical, but they rhyme, I pay attention. Now go to Riverside, same flavor. Redfin shows a March median around $633,000, basically flat year over year. But days on market? 49. A year earlier, 41. So again, not a collapse. But the market is slowing, about a week longer to find a buyer. CAR's broader Inland Empire release shows the regional median down just 0.2%. And Riverside County itself was slightly up. So let me be careful here. The Inland Empire is not collapsing. That is not what I'm saying. But the pattern is clear. The city-level data looks softer than the regional headline. And the listing-level behavior looks softer than the price level. That matters, because a market can look fine in the median and still feel very different on the ground. More days, more cuts, more negotiation. There's also a private firm called Reventure app. They pulled the Riverside San Bernardino price cut share for 2025, and they found it at the highest level since 2018, roughly 4 times the 2021 low. Again, not an official government statistic, but it lines up with what Redfin is showing. And when multiple sources start pointing the same way, I don't ignore that. So if you're shopping in Sacramento, Riverside, or a lot of the Inland Empire, you have leverage you did not have 18 months ago. Listings are sitting, sellers are cutting. There is room to negotiate, and if you were around in 2021, you know how different that feels. Back then, in a lot of places, you didn't negotiate. You survived, you showed up, you waived things, you hoped. That market is not this market. But, and this is important, not every inland submarket fits the same pattern. Some tighter submarkets are still running under 3 months of supply. So no, I'm not saying every inland market is suddenly a buyer's market. The shift is real, but it's lumpy. Now let's look at the other California. Same state, completely different planet. San Francisco Metro, March 2026 median sale price, $1.7 million. Year over year change, up 14.4%. That was the biggest annual jump since March 2018. The biggest jump of any of the 50 most populous metros in the country that month. And San Francisco took back the title of most expensive major metro in America. Supply? About 1.8 months locally compared with 3.2 months nationally. So if you stop reading there, the story sounds simple. San Francisco is back. The post-pandemic death story was wrong. Victory lap, end of story. Except, not really. Because when Redfin breaks the same metro into price tiers, the whole story changes. Almost all of the gain is concentrated in the top 5% of homes. Luxury sales were up 22% year over year. 5th straight month of double-digit luxury growth. Median luxury sale price about $6.8 million, record for that time of year. Now pull the luxury tier out. What happened to the rest of San Francisco? 0.1%. 0.1. So technically, San Francisco is up double digits. And technically, the typical non-luxury home barely moved. Both are true. At the same time, that's the whole problem with the headline. It tells you one of those truths and hides the other. Compass, the brokerage, had its own version of this in early April. By their numbers, The metro single-family median hit 2.15 million. 22 houses sold above 5 million in a single month. Record. 24 condos above 3 million. Also a record. And Compass's chief analyst connected a lot of that to AI startup wealth. Bloomberg and the LA Times carried that framing. Now, I want to be straight with you. That is a brokerage talking to reporters. It is not an academic study. It is not official state causation data, but it does fit the pattern. The gains are concentrated at the top. The wealth story is plausible. And right now, there isn't some strong competing explanation that makes more sense. So I treat it as the best story on the table. But I keep a little distance from it because data and attribution are not the same thing. One more thing, CAR's November 2025 read had the Bay Area median down 3.2% year over year. So this market turned. What's happening now is not what was happening 6 months ago. Now let's tie the two halves together. Lock in. The LAO's Q1 2026 report says around 77% of California homeowners are sitting on a mortgage below 5%. Today's rate is north of 6%. And for a typical owner, the lifetime cost of trading that old rate for today's rate is about $180,000 over 30 years. $180,000. Nobody looks at that number and says, yeah, I'll move. Nobody. That's lock-in. And lock-in starves both halves of the state of inventory. But the downstream effect is different. In the Bay Area, you have tight supply, concentrated wealth at the top, and return to office pulling demand into specific zip codes. So when high-end demand shows up, prices can move fast. Inland, inventory is also tight. Same mechanism, but the buyer pool is weaker. Fewer buyers can qualify at 6+% rates in the volume needed to push prices up. So the symptom is different, not a luxury surge. Longer days on market, more seller concessions, more price cuts, same lock-in, different demand environment, different outcome. And the LAO has the buyer pool number 2. Around 23% of California households can qualify for a mid-tier mortgage today. In 2019, that number was 31%. So the top end still has buyers. The middle has thinned out, and that's the split. California is not crashing. California is not booming. California is splitting by tier, by geography, and by who has access to capital that does not care about a 6% mortgage rate. Now this part matters because some of the softness in inland markets is not just about price. It's about payment structure. And that's why in new construction-heavy submarkets, the list price may not even be the real price. Picture this. You're walking a new development in Folsom or Menifee or any builder-heavy market. 2 houses, same square footage, same list price. One is a brand new build from a national builder with the company's in-house mortgage arm attached. The other is a resale across the street. On paper, the list price is identical. But when you actually qualify for both and run the monthly payment, the builder's house can come in materially cheaper. Why? Permanent rate buydowns. The big national builders are using captive lenders to finance buyers below the prevailing 30-year fixed. The list price does not move, the monthly payment does. The American Enterprise Institute ran analysis on this. The Wall Street Journal and Inman covered it. Roughly 2/3 of homes sold by the biggest U.S. builders included permanent buydowns. Again, private analysis, not an official government statistic. But the gap was big enough that AEI flagged a scenario where FHA buyers could end up underwater on the loan from day one. That is not a normal thing for an analyst to say out loud. And Lennar, one of the 2 biggest builders in the country, basically admitted the quiet part on its Q1 2026 investor call. Revenue down 13% year over year, new orders up 1%, and the company described rate buydowns as the mechanism they're using to keep volume up. That tells you everything. The buy down is the deal. So if you're buying in a builder-heavy area right now, stop treating the list price like it's the price. Closing cost credits, buy down funding, repair credits. Those are real again in 2026 in a way they were not a couple of years ago, and a rate even 1 point below market can change the monthly payment meaningfully. If you're on the other side, trying to sell a resale a mile from a builder with the same list price, understand what you're really competing against. Your competitor's house may be cheaper than yours. The list number says it isn't. The monthly payment says it is. Buyers are figuring this out. Resale sellers are late. Okay, let's make this useful, because data without a decision is just noise. If you're buying, the first question is simple. Where in California are you actually shopping? Because the playbook in Folsom is not the playbook in Mountain View. Those are different games. If you're inland or in a builder-heavy submarket, treat the list price as the starting number, not the final number. You want to price the deal in monthly payments, with the buy down in your math, because that is exactly what your competitor at the closing table is doing. And I'm going to be a little blunt here. Stop using the state median as your reference point. It is not helping you. Pull the Redfin page for your specific city. Pull the Zillow Home Value Index. Look at days on market. Look at price cuts. Look at your price band. Write your offer from the local data. The state median is background noise. That's it. If you're selling, the question is different. Are you competing with new construction in your submarket? And if you are, have you adjusted for the buy down gap? Because same list price as a builder home is not the same offer. Not to a buyer, not to a lender, not to the monthly payment. And honestly, that might be the thing that decides whether your house sits or sells. Look at days on market in your city over the last few weeks. Not last year, not some statewide average. Your city, your price band, your competition. And in 2026, the lever that closes the deal is often not the price. It's the structure. A closing cost credit can move a buyer. A repair credit can move a buyer. A rate buy down can move a buyer. Sometimes a price cut is not the sharpest tool. If you're renting or you already own, the rent versus buy math has also changed. The LAO says owning a typical 2-bedroom in California now costs about 66% more per month than renting one. And that gap has widened in 33 of 47 counties since 2020. So whatever rent versus buy advice you got in 2018 or 2019, it is not the same calculation anymore. So look, the state-level record story is not wrong exactly. It's just very loud about a handful of zip codes and very quiet about almost everything else. Most of California is closer to flat with softness than it is to records. And the headline number is doing a lot of work to hide that. If you're shopping right now and you only remember one thing, make it this. The median is background noise. The page you should be on is your cities. Last few weeks. That's it. Sources are linked below. This is market commentary, not personal advice. For an actual decision, talk to a licensed professional in your area. And if you're up for it, drop your county or metro in the comments and tell me what the last few months have felt like where you are. Softer, tighter, about the same? No addresses, no dollar amounts, just the local read. That helps me decide which markets to dig into next.